Hi there, I'm Lindsay Biscaya. Welcome to Market Call. Dan Rohinton is on the show today, Vice President and Portfolio Manager at IA Global Asset Management, and he'll be taking your questions on Canadian and global large caps. Here's how you can reach us. You can call us toll-free, 1-855-326-6266, or you can send us an email to marketcall@bnnbloomberg.ca. And Dan joins us now. Dan, it's good to see you. Thanks for joining us.
Hey, thanks for having me.
This is, it seems as though it's going to be another interesting week when it comes to volatility in the markets. I'm wondering what you're watching for as this kind of conflict in the Middle East goes on.
Yeah, I think the best way to just look ahead from where we are today is looking at what are the data points that are going to filter through for a prolonged period of time. So I'm looking at where inflation can be, where interest rates can go over time. And that's really the things that will endure longer than anything that you see in the headlines in the newspapers today, which could resolve in a very short period of time, frankly. So the oil shock can be temporary, but the lasting effects in terms of inflation, that's where you really want to keep a closer eye.
Right, because you say despite the volatility, you think it's creating pockets of opportunity for some investors. Tell us more about that.
Yeah, I think what's interesting about this environment is that when you see the market selling off as a whole, there's actually a lot of stocks out there that you would say, wait, does that make sense? Is that actually appropriate for where we are in the economic cycle? So I think what we're seeing today actually makes me a little bit interested, more than a little bit interested, I would say, in just blue chip companies that deserve basically higher valuations and have more durable growth rates than the market is giving them credit for today.
Okay, so what companies or certain sectors are you kind of watching for? Do you like amid all this volatility?
I think what's interesting is there are actually companies that you're all familiar with. And what's unique about this environment is some of the bigger cap stocks, you think of your Microsofts of the world, think of your Metas, your Googles, your Amazons are phenomenally well positioned for where AI is going at the increment, along with their general defensibility, that they are trading at pretty big discounts relative to their own history. And you could be picking up low debt, high growth companies at pretty attractive valuations. So I would say big tech as a whole, as a general characteristic, but there's more specifics that go underneath the hood there.
And you also say stock selection matters more than ever this year. Why is that?
The reason it matters is when you look across the different sets of companies, the bottlenecks tend to move. So AI is called it the biggest cross-sectional theme that you've seen across the entire market. But where you look under the hood step by step and how that value capture changes is a lot more important than it used to be. And one simple example, Lindsay, is when you think about all the excitement has been on memory stocks. But NVIDIA has seen a lot of relative derating, and it's trading at a huge discount. So that pendulum swinging from where you are in the bottleneck, going all the way back to the core, call it bundler, if you will, is just one little example of what you see elsewhere across the rest of the portfolio and the stock market as a whole.
Okay, so we're going to take another quick break right now, but we will be back with Dan Rohinton of IA Global Asset Management, taking your questions on Canadian and global large caps. Here's how you can reach us. We'll be back in just a moment. Stay with us. Welcome back to Market Call. Dan Rohinton from IA Global Asset Management joining us today to answer your questions. Dan, we're going to go to an email question first. This is coming in from Peter, and it reads, what would you add to PPL at today's price? Would you add to PPL at today's price? So Pembina Pipeline, obviously, another energy company that has been benefiting from what we've been seeing recently. What do you think?
Yeah, I think overall Pembina well managed, decent distribution as well. So when you think about Enbridge, TC Energy, Pembina, the big companies in the Canadian landscape for the midstreamers, I'd say they're attractive opportunities today, but you do have to have the medium-term view that the oil price shock has some persistency to it. So it's really not about Pembina, the company itself, but do you have a view that energy, and specifically Western Canadian energy, is going to remain at the bid premiums that we have seen? So any sequestering of volumes that the US would do and basically forcing the pain to the rest of the world, if it were to persist, are risks that you do run. So I am a buyer. I think it's one of those companies that you average into over time. But I would have to say, from where we sit today, you should probably be a little bit careful to add here.
Okay. All right. We're going to go to the phone lines now. Jim is calling in from Peace River, Alberta, with a question. Hi, Jim.
Hi. I was wondering about Synovus, please. I already own them. Is this a good place where I should maybe add a little bit more? What's your opinion? Thank you very much. Bye.
Thank you. Dan, what do you think? Synovus Energy?
Yeah, so I'll actually just kind of copy and paste my comments a little bit just with a higher risk profile for Synovus. So I'd say generally speaking, it's really come a long way in terms of how the assets are managed. And it is a little bit further out the risk spectrum than Canadian Natural Resources, which tends to be my go-to in the Canadian energy patch for the producers. But I do think, once again, it's an opportunity today if you believe that energy prices will remain robust and strong for a prolonged period of time. So I'd say, once again, be a little bit careful that I would say be a little bit careful for where we sit today, but don't bail on it over time. So dollar cost average carefully.
Okay, back to the phone lines. Chris is calling in from Delta, BC, with a question. Hi, Chris.
Oh, good morning, Lindsay and Dan. Thank you so much for taking the call. Dan, there's about 19 different stocks I'd love to ask you questions on now, but my number one is going to be LVMH that you recommended in the past, and that's not why I've owned it. I've owned it for almost 6 years now, and as you can see, it's really come down, and I've been buying when others have been fearful lately, and I'm just wondering if you still think that this is a good long-term opportunity for someone who can be patient, 30-year-old long-term investor in a TFSA. I will hang up and listen. Thank you so much.
Okay, thanks, Chris. Dan, what do you think?
Yep. Thanks, Chris. So I fully agree with that. And we're still buyers of LVMH today. I think it's derated quite a bit. And the best way to think about what's been going on with the stock more recently has been the weakness and call it the strong demand during COVID in China. They've been working through that. But then what we've had the recent oil price shock, and basically there's less discretionary money to go buy expensive handbags if you're paying more at the pumps and things like that. But you take a step back, I think this is a buying opportunity, and I would continue to average into it today. I think it's interesting, and we're buyers today in the portfolio because the brands are everlasting. Louis Vuitton is iconic, and you have the ability to take price on customers over time, but you just have to work through this shock right now.
Okay, back to the phone lines. Elliot is calling in from Hamilton, Ontario, with a question. Hi, Elliot.
Good afternoon. Historically, a good steady grower, First Service Corporation has fallen on hard times. Is this a broken company or a broken stock? And what would you do if you had a 220 cost base? Thank you.
Okay, thanks for your question. Dan?
Yeah, I think First Service, they're basically property management. They do it really well, and they've been expanding more in the United States. The thing with First Service as a whole is it's not really, call it good company, bad stock. And the reason why the stock would be a little bit on the weaker side has just been the starting valuation has also been quite high, right? So when interest rates go up, anything with a high multiple is even more sensitive. So I do think it's interesting. If you're a long-term buyer, I wouldn't stop you from averaging into it slowly and continuously. It still trades at a modest premium, but I think the biggest valuation pressure that we've seen over the last few years is largely behind us. So I think it's interesting, and I'd lean more buy than sell today.
Okay, maybe a good time to buy in the dip before the housing market rebounds a little bit. We're going to go back to the phone lines. Dave is calling in from North Bay, Ontario, with a question. Hi, Dave.
Hi, happy Monday, Dan and Lindsay. My question's on Micron Technology. It's had quite the free fall the last few weeks. I do own a small position in my TFSA. My question is, would you consider this a good long-term hold? And if you own the stock right now, would you be buying at today's levels? Thank you.
Yeah, thank you for your question. Micron even just today down almost 7%. Dan, what do you think?
So I think it's important to first say congratulations, because the stock's up 400% in the last 9 months. And I think that's why it's important to just zoom out just a little bit in this discussion, because what is going on right now is actually a shift in terms of where the profit pools are. So memory has done really, really, really well because there's a huge shortage of it. And it takes a few years to build up these plants, but the chips and the data centers want it right here, right now. So prices have risen, I believe, almost 100% per quarter for the last 2 or 3 quarters now. So once again, congratulations. I would say this is not a long-term company to hold on to, primarily because this is known as a deep cyclical. So there's times where you make $100 per share, which is what they probably will this year. And there's times where you lose money, which could be next year or the year after that. The reason why Micron at 330, I think, is probably worth holding on to is this memory shortage is more structural in nature. And although you can spec out, basically design away some of the memory bottlenecks that do exist, it is a tough slog to get it done. So expect 2 to 3 years of super, super normal profits. The stock is going to perennially look through that, and you want to own it for the second year of the profitability, because the third year, the market's going to look towards the negative earnings potentially that come after that. So I'd be very cautious. It's not long-term, but I do think it's cyclically interesting. But you have to remember, you're already up hundreds of % on the stock. So congratulations.
Okay, Dan, thanks for that. We're going to take another quick break, though. We will be back with Dan Rohinton of IA Global Asset Management, taking your questions on Canadian and global large caps right after this. Stay with us. Hi there. Welcome back to Market Call. We're going to go right to the phone lines. Kevin is calling in from Kingston, Ontario, with a question for Dan Rohinton. Hi, Kevin. What's your question?
Hi there. Thank you for taking my call. Your guest is very thorough in his responses, and I really appreciate it. And I enjoy when he's on. My question is on the TD Bank. It's had a really good run over the last 9 months or so. I think the issues in the U.S. are behind it. It's still paying roughly a 3.5% dividend return. I'm wondering if the guest would be buying at this price level. I think it's around 128 and change, or somewhere around there right now. Would he be adding, or does he anticipate pullback? Thank you.
Okay, thanks, Kevin. Dan, what are your thoughts? Would you add, or do you expect to pull back?
I'm not a buyer here, but I also, once again, just goes back to your time horizon. If this is something you've held on for years, I wouldn't say this is a reason to sell either, but I'm not a buyer today. The reason why is when you think about the U.S. is behind them, not mostly, as in the fears of it are largely priced out of the stock now. But when you look ahead, the real question comes down to, where does the Canadian consumer, does the Canadian housing market come back to life? Because that really is the engine of TD's growth and profitability, whereas the U.S. has been a lot of distraction and a lot of headache and heartache, if you will. So I think TD's mostly fully priced today. So I wouldn't sell if you're a long-term owner, but I definitely wouldn't be a buyer today.
Okay, thanks, Dan. We're going to go back to the phone lines. Henry's calling in from Thornhill, Ontario, with a question. Hi, Henry.
Hi, thank you very much. I'd like to know about Novo Nordisk. It does seem to be a good drug pipeline with regard to research and new drugs coming on stream. And the last time they had a new drug on stream, the stock tripled. And then, of course, they had the competition with Eli Lilly for the same basic weight loss drug. But they've got other drugs in their pipeline, and right now, Novo Nordisk seems to be at the bottom. Do you think it's a good time to buy it?
Okay, thanks so much for that. Dan, yeah, Novo Nordisk trending down at the moment. What do you think? Buy on the dip?
Yeah, so it's actually, I'll just maybe set the table a little bit. So the drug that the gentleman's talking about was Ozempic and Wegovy, which is the weight loss version of Ozempic. No, it's hard to understate how big of a launch that truly was. So when you think about the actual launch cadence of a drug like that, there's few blockbusters that are this big. And the reason why Novo Nordisk has been weak of late is Eli Lilly has been surpassing them in terms of clinical trials and pipeline in the obesity therapeutic area. So I'd be cautious to say drug launches and pipelines are equivalent. Novo Nordisk is behind, which is why you can get it for 10 times earnings today. But I think what you're really realistically signing up for isn't the hope that it doubles or triples and gets back to where it is in the past. It's that you get a dividend yield and maybe you don't lose too much market share along the way. But They are the worst therapeutic on obesity. They don't have the pipeline anywhere near what Eli Lilly does. And that's why it trades at the big discount it does. So you're buying a regular pharmaceutical company with a decent yield, and I wouldn't price in too much more than that. So do I think it's a screaming buy today? I don't, but do I think it makes sense as part of a broad diversified portfolio to add a little bit here and there? Sure. But it is not a touchstone, cornerstone, foundational position in any sense of the word.
Got it. Okay, we're going to move on. Peter's calling in from Alliston, Ontario with a question now for Dan. Hi, Peter. Hello? Okay, he's not there. We know he was going to ask about Nike, though. I'm not sure, Dan, if you have thoughts just on how Nike's been doing as of late and whether you think it's a buy, a hold. What do you think about this company?
Yeah, I think when you think about Nike as a whole, you just because we all know the name and know the Air Jordans and things like that, we shouldn't confuse it with the business of Nike itself versus the brand mindshare that it does have. Nike is more of a turnaround, and the thing with Nike and others that they do have to contend with is they won't trade at the premiums that they used to. So do I think it's a tactical buying opportunity? Perhaps, but I wouldn't say this is a structural long-term hold. And the reason I say that is the environment for basketball shoes versus running shoes versus other types of hobbies and things like that are coming up. It's a lot more fragmented of call it an athletic world than it was in years past. And I think that the way you draw attention and fight for attention is also difficult compared to where it was in the past, where you just can basically dominate the landscape with your big ad buying programs. So I think the balkanization has meant that it is a bit more of a tougher slog. So cyclically, tactically, sure, I would buy Nike, but I wouldn't say this is part of a long-term TFSA or an RSP.
Right, because I was just looking, and apparently Nike shares are down 18.4% year to date. It's only March, but would that concern you at all?
It's there's a lot of stocks that are high quality that are down that amount, and it's really the 40 times earnings, the 50 times earnings that Nike used to trade at for brief moments in time. I think those days are over. So I don't think it's overly sold off versus the rest of the market. And if I may ramble a little bit, Lindsay, the reason why is, once again, along with restaurant stocks and other consumer discretionary goods, the more the gas pump costs, the more food costs, the less space there is in the budget for a new pair of Air Jordans. So that's really the reason why discretionary, including Nike, has been weak. But I don't think that's unique to Nike as we start the year.
Yes. Okay. You were saying that about Louis Vuitton as well. Okay. We're going to take a quick break right now. When we come back, though, we will take a look at some of Dan's past picks. That's coming up next. Stay with us. Welcome back to Market Call. We are going to go through some of Dan Rohinton's past picks now. These are from May 2nd, 2025. So, Dan, your first one was Amazon when it was recommended at $189.98, now at $201.39, 6% return. It's been a bit of a rougher start to the year for Amazon, but you still holding this one?
Yep, I think it's a pretty attractive opportunity. The best way to think about Amazon and where it sits today in terms of its positioning is the reason the stock isn't actually up a lot more than this is the heavy investments they're making in AI. And that's what took the stock down from called the 240 to 210 level from earlier in the year. And that's that announcement of we're going to spend a whole boatload of more money for AI data centers. I'd say investors have to come around to the idea that that's a great idea and not actually a negative. So I view what Amazon is doing not as a weakness, but as a source of strength and leaning into their scale and distribution advantages. So I'm a fan. It's a big holding for us today, and I would continue to strongly advocate for Amazon from where we sit.
Got it. Okay, so next up is GE Aerospace. So back in May of last year, you recommended at $207.70. This one's now at $274.37, up total return of 33%. This did well for you so far.
Yeah, we'll take it. And I would, once again, funny enough, a lot of the stuff we own, we continue to own, like the LVMHs of the world. I think it's interesting. I would continue to own it. It's a little bit less attractive. It's not a blow the doors off opportunity, but when you think about why the stock went from 350 to the 270s, I think it's an interesting buying opportunity from where we sit, primarily because, Lindsay, the reason why the disruption has been regarding the conflict in the Middle East and the lack of air miles traveled. But once again, when you think about a business like this, your backlog is sold out for years. You have strong margin upside on servicing. It's a razor blade model just with aircraft engines. But these are all good news stories that last decades. They're not beholden to a few months of pain here and there. So I think it's interesting, nowhere near as attractive as Amazon on an absolute basis, but I still think it's a buy today.
Okay, and your last one, I'll admit, I haven't heard of this company before. I hope I pronounce it right. It's Danaher. And this one maybe didn't do as well for you, recommended at $199, just over that now at $183. So this company designs and manufactures a number of different things, right? Are you still holding this one?
This one we're actually selling out of, and it's more of a function of shifting to another opportunity, call it tomato, where their peer Thermo Fisher Scientific, we've actually taken our position in Danaher and added it to Thermo Fisher. And the reason behind it is that there's more that Thermo Fisher has within its wheelhouse that they can control versus Danaher that is more reliant on doing more deals to fill out its broader portfolio of diagnostic equipment and bioprocessing tools. So the best way to think about what they do is they serve pharmaceutical companies and help with the drug discovery and operationalization pipeline. So they help Novo Nordisk basically build the Ozempic, if you will, physically. All the stocks in the tool space have been weaker, largely for a whole swath of reasons from, I'd say, misguided fears around AI, along with lower demand for R&D. But I think as a whole, I would be more inclined to buy Thermo Fisher than I would Danaher, although they've been both selling off at around the same rate in the last 2 months.
Interesting. Okay, we will leave it there. We'll be back, though, with Dan Rohinton of IA Global Asset Management, taking your questions on Canadian and global large caps right after this. Stay with us. Welcome back to Market Call. Dan Rohinton is with us today from IA Global Asset Management, taking your questions on Canadian and global large caps. So, Dan, we're going to go back to the phone lines. Peter's calling in from Belleville, Ontario, with a question. Hi, Peter.
Oh, hi. I'm calling about Dollarama. Held it for a number of years. I bought more when it went down quite a while ago because of the investment in Calgary, and I thought it was a buy-on opportunity. But I'm mystified why now Dollarama has dropped well below its 200 level.
It's a good question. Okay, thanks, Peter, for that. Dan, got any answers to that drop?
Yeah, I think there's probably, once again, remember there's a whole host of, call it a witch's brew of things going on in the global economy that lead to consumer spending and the impulse there being a little bit worse. So you could chalk it up to higher interest rates and the lack of rate cuts potentially pressuring future demand for customers that would be shopping at Dollarama's and other types of discretionary products, right? I think it's also important to say, even now, the stock's 33 times earnings. So higher valuation stocks as interest rates are rising tend to get hurt a lot more too. So valuation plus the fact that, copy and paste my Nike comments and my Louis Vuitton comments just for chocolate bars and other more snack related items and seasonals for Dollarama, I think that's all true. I think the other thing to take a step back over time for Dollarama is they are on the other side of a phenomenal growth runway. And what I mean by that is they aren't opening up as many Dollaramas as they were in the past, and the returns on those aren't as good as they would have been 5, 10, 15 years ago. So this is a far more mature company than it has been in the past, and that growth is a lot harder to come by, and that's why they've been going to, I believe it's either Central America or parts of South America to really push that initiative forward. And it's just a lot different and a lot less profitable than growing and opening up the next store in Toronto or parts of Vancouver and so on and so forth. So high valuation, wrong side of consumer, plus the wrong side of the long-term growth runway doesn't mean that it's not a buy in the future. I would just say, don't assume that this is an impulsive opportunity to buy the dip.
Got it. Okay, so maybe just hold off for now. We're going to go back to, you would wait. Yeah, we're going to go back to the phone lines. Mike is calling in from Cabo, Mexico with a question. Hi, Mike.
Good morning, Lindsay. Morning, Dan. I got a question on Go Easy, long-term holder. As you know, with the great pullback there, is it time to dip my toes in at this or just hold? And do you hold it, Dan? Thank you.
Okay, thanks for that. Dan, what do you think? Do you hold at this point?
It's a really tough question. And the reason I say that is, there's this thing called cockroach theory, where if there's one cockroach, there's probably many more. So you want to be extremely careful in environments like this. So this is the company that is, call it payday lending, furniture financing. They're the ones that'll rent you a lamp at a credit card rate plus, right? So it's sensitive to consumers that are going to be feeling the pinch from higher interest rates or just cost of living increases. So it's already serving a customer that's having a tough time. So adding on the fact, call it financial irregularities, if I can put it generously, I would be very, very, very cautious to buy more. So if you want to take a flyer and say, this is my gambling money, then I'm going to put a few $100 in. Okay, I can get behind that. But I would say I'd be very careful to put this as part of a core diversified portfolio, because there is a lot of smoke and a lot of cockroaches in terms of what they've been up to, on top of the fact that their customer base is under pressure.
Interesting. Okay, we'll leave it there with that company because we've got Mark calling in from Manitoulin Island, Ontario, with a question. Hi, Mark.
Yes, hello there. My question's, I'm just looking for a play in the energy area, something perhaps maybe Brookfield.
Okay, thanks for that. Yeah, I think a lot of people may be looking right now, Dan, for something in the energy area. Do you think Brookfield, or is there something you like better?
I'd say energy in terms of Brookfield. There's different types of energy, right? So energy could mean, if you mean oil and gas, then I'd say, just start with Canadian Natural Resources. If you're thinking energy in terms of grid powering, electrification, things like that, then Brookfield Renewable Energy Partners would be one of those companies that fit well into that fold. So it comes down to, quote unquote, what type of electrons are you looking for, and how that fits. But Brookfield, if I can just lean into that part, it's contracted cash flows with the ability to recycle that capital into new projects in a world that is short electrons and looking for more of it to power more compute resources. So that's how I would frame that broader discussion. On the other side, when you think about energy, the good old-fashioned dinosaur juice, I would say look no further than Canadian Natural Resources. Well-managed, stable asset base, low decline rates, which means that the production doesn't just fall off a cliff. I think that's a great place to be there. So you have to have the view on the dinosaur juice energy companies that this is going to be a persistent theme, because otherwise they are going to see some pressure. But within that cohort, I'd say Canadian Natural, if you had to put a gun to my head.
Okay. Okay, we're going to go back to the phone lines now. Jacob is calling in from Barrie, Ontario, with a question. Hi, Jacob.
Yes, hello. Good afternoon to both of you. I'd like to ask the gentleman about Brookfield. About Shopify. And do I hold it, sell it, or keep it until the end of the year? What do you think of that? Do you also own it in your portfolio? Thank you, and have a nice afternoon. Bye-bye.
Okay, thanks, Jacob. Dan, thoughts on Shopify?
So we don't own Shopify today, and I'd say that's not really a direct indictment on Shopify in any capacity. I actually think it's really well managed, and there's two things to think about with Shopify. The first one is, what is the role of agentic commerce, and do they have a pole position? Can they really anchor themselves in an agentic commerce world? And I think they're making every attempt at doing so. The question is whether or not they will succeed or not. And I think I would just wait on answering that question, because I think it's too soon to know for sure. And other players like Amazon and Walmart will actively be trying as well. The second point on Shopify, you have to remember these are not cheap companies. So whenever you have a market darling, a cult stock like Shopify would be, facing big existential questions about its future, that usually means the valuation compresses more. So I do think there's probably more downside risk to Shopify, and that's not for a lack of effort on their part to get it right. It just comes down to sometimes you can't control the environment and the industry you're in, and their industry is going through some change right now. Their job is to figure it out and capture it, but I don't think that the jury's out on that yet. So I wouldn't be a buyer today.
Not a buyer today. Okay, we'll leave it there, Dan. We're going to be back in just a moment with Dan Rohinton of IA Global Asset Management, taking your questions on Canadian and global large caps. Here's how you can reach us. We'll be right back. Welcome back to Market Call. Dan Rohinton is with us today answering your questions, and we're going to go right back to the phone line. Salvatore is calling in from Mississauga, Ontario with a question. Hi there.
Hi. Yes, I have some thoughts on Kinaxis. Would you buy? I've been holding it for a bit now, but I'd like to know, is it a good time to add?
Okay.
And
Okay, thanks for that.
Yeah.
Holding the company for a little bit. Well, Dan, what do you think? Good time to add or just hold on to what you have?
I'd say, you know what? It's tough because with Kinaxis, the stock's derated quite a bit. So this used to be a pretty premium valuation company in the context of the Canadian market. They do pretty complex supply chain software. So they have really their hooks into their customers more so than other companies would. But I would say save money in your software budget, which is Kinaxis, a classic software company, for Microsoft, maybe ServiceNow, maybe Workday, which are trading at half the valuation that Kinaxis is. So I wouldn't say sell it here because I don't think they have any right to lose their market share or get abstracted away, as it's known, where something else just takes on the importance and you just become more of the dumb commodity underneath. But there's bigger companies, more durable companies at cheaper valuations. So wait for the top picks on my part, and also think about ServiceNow and think of Workday because it's many flavors of the same theme, which is software getting commoditized and the most durable parts of software being able to figure it out and find a future from here.
Yeah.
So hold on to it, but I wouldn't rush to buy more.
I was going to say it's going to be interesting to figure out which software companies you can kind of rely on and which ones might be made redundant, really.
That's right.
Yeah. Okay, we're going to go back to the phone lines. Ben is calling in from Toronto, Ontario with a question. Hi, Ben.
Hi, how are you? I'd just like to thank you for taking my call. I have Fairfax Financial, which has been great. I'm just wondering, is it worth to buy more? I have the ability to. And what do you think the projections in the growth, even though they don't pay much of a great dividend, what are your thoughts on it? And thank you.
Okay, thanks for your question. Dan, thoughts?
Yeah, when it comes to Fairfax, so just quick history lesson, the business from an underwriting basis has really improved quite a bit. At the same time, they didn't suffer the interest rate shock in 2022. So it really came out ahead where having a low duration bond portfolio at a time when rates are rising, they really won in a lot of different respects. It's a lot more stable of a franchise than it has been. And really you're marking time. I would say it's not the most barn burning. I think maybe the best way to summarize it is there's no reason to sell because it is well managed still. It is still going to have a good ability to reinvest its cash flows into longer duration bonds. So all of that is fine. So business as usual is Fairfax. I just don't think it's the most obvious buying opportunity in the market. So if you want to add to more financial services, sure. But I think you should be thinking about more big internet and more blue chip stocks that are trading at bigger discounts in the market that we sit in today.
Do you have any ideas in terms of companies specifically, or just kind of look in that sector, look in that area?
Yeah, it was. If you think about just what I was saying around, think of the Amazons of the world, think of the Microsofts of the world, think of the Googles of the world and the Metas, where they're trading at, relatively speaking, huge discounts to their own history, versus Fairfax is largely speaking within its normal range, within its normal operating environment. So I say, in financials, it's fine, and we do own it in our Canadian portfolios, but it's just not, it doesn't, in a market that is selling off and creating a lot of opportunities like this, I'd look to big internet like the stocks I just mentioned, more so than Fairfax.
Okay, got it. We're going to move on to an email question now. This one's coming in from George, and it reads, please ask your guest if Intel is a buy, sell, or a hold. Dan, what are your thoughts on Intel at this moment?
Yeah, it's a really interesting one. So Intel, the best way to think about it is it's the turnaround that's fully priced, but it's also seeing a huge spillover demand from the fact that Taiwan Semiconductor is fully sold out. So you're taking on more risk than you might think, despite the stock being down over, call it a multi-year period of time, 5 and 10 years out, because a lot of Intel the valuation today in Intel is reliant on the turnaround and a huge bottleneck in what's known as CPU or x86 chips demand as we look ahead, which I believe, I would just say you could probably get it more de-risked through Taiwan Semiconductor. TSM is the US ADR line. I would be a lot more comfortable and sleep a lot better at night owning that. Although I'll acknowledge you can make more, if I'm right on TSM, you'll make more money on Intel, but I would just rather get a good night's sleep if I had to choose between the two.
Okay, and we're going to be talking about Taiwan Semiconductor coming up a little later in this show, so we'll move on to another email question. This one's coming in from Kevin, and it reads, would like to get your guest thoughts on Canadian Pacific Kansas City as a long-term hold for 5+ years. Canadian Pacific Kansas City, Dan, what do you think about a long-term hold for this company?
Yeah, I think it's interesting today. I'd be a buyer today. It's largely a function of valuation and the fact that volumes have been really, really tough in this environment as a whole. So part of what I would say is there's a few things going on. So first is that the industrial goods economy has been softer than what investors would have expected. That's why the choppiness has happened over the last few months, if you will. A lot of hype, and then bad news comes out, so it starts trading back down. So that's the chop. The underlying medium-term theme that's going on is the rail space has been very interesting because first there was CP and Kansas City merging together, but now there's actually mergers that are rumored, and the first one with Union Pacific actually fully in the throes of being executed, where your footprint might not be as competitive as it used to be. That being said, there's a role for CP KC to play in the future. In terms of the future mergers that might come, we might end up in a few years from now, the 5+ year horizon, where we don't have 4 or 5 rails. We might have 2 mega rails together because we've had 2 triple mergers that are happening. So a lot of, call it, speed dating has been going on. CP is not immune from that. So expect more noise. But I do think from the valuation, from expectations, where we are in the cyclical recovery, I think it's worthwhile holding on to it and adding where we sit today.
Okay, we'll leave it there. We're going to take a quick break once again. When we return, though, we'll take a look at Dan's new top picks. That's next. Stay with us. Join us tomorrow on Market Call. Mike Van Oker will be on the show. He's portfolio manager and senior wealth advisor at Papellis Wealth Partners, IA Private Wealth, and he will be taking your questions on North American large caps. Okay, time now for top picks with Dan Rohinton. So Dan, we'll go through these one by one. One of your top picks is Microsoft, and you have acknowledged that the market is punishing Microsoft for their AI capex, but you still like this company. What do you like about it?
Yeah, I think what's interesting about Microsoft is it's a very specific view of the world that you have to think Microsoft is deeply attractive today, which I do. You have to believe that the big spending that's going on in AI, all of the value isn't going to automatically flow into just the big foundation models, call it your OpenAIs, your Claude, Anthropics, your Google Geminis. That having a distribution platform like Microsoft Copilot and the full application suite, which is what Microsoft has, your Excel, your PowerPoint, your Word, being able to squeeze the middleman is what Microsoft can do, and I believe will do, along with having a really prolific cloud computing business. So I like it because it's cheap. I like it because they have the ability to manage it. I like it because it's well run. And the opportunity exists today primarily because investors believe all of the value is going to go to the OpenAIs and the ChatGPTs of the world, where I think in the future it'll turn out to be a bit more of a balanced conversation. And I think that's the valuation opportunity and the earnings opportunity for Microsoft as we look ahead. So I think it's interesting as part of a diversified portfolio.
It's such an interesting one-year chart for Microsoft. I've seen that a couple of times now, and it's really been dropping recently. You say, do you think there's still a race, though? An AI race between some of these big hyperscalers, or not so much?
It's a white hot race, and it's going on, and it's going to continue to escalate. But you know what's interesting about, as we look, if we zoom back literally a year ago, you'd be forgiven for thinking that the company was growing slower today than it was back then. So Microsoft was growing its cloud computing business 31% per year, which is, once again, enormous numbers at their scale. When you have $50 billion of revenue and you can grow 30%. They were growing 31% last year at this time. This year, they're going to be growing over 40% on a bigger revenue number. So the market is even more pessimistic about Microsoft today than it was a year ago.
Wow.
And I think that creates a bigger opportunity where we sit today.
For sure. Okay, next up, we were talking about this earlier. Taiwan Semiconductors is your next pick. Why?
It's the cornerstone of all things AI. So when you think about a company that owns 72% market share of where all the most prolific chips that enable all these AI breakthroughs to come about, Taiwan Semi is that company. And it trades at a discount to Microsoft. It trades at a discount to all of the other companies, despite them doing the hardest engineering work that they do. So think of this as a manufacturing company. It's called a foundry as a whole, and it's Logic Foundry to be specific. And you're talking about a company that could grow 20 to 40% in the next few years on a consistent basis as they build out this capacity, trading at effectively the multiple of the market when they have effectively a monopoly on where the future innovation is. So I think it's interesting as part of the semiconductor AI allocation, as part of a diversified portfolio.
Okay, we don't have a lot of time for this last one, but we'll go through it quickly. Visa, despite seeing a sell-off recently, you like Visa?
This is ironically the other side of the coin, where it's viewed as an AI loser. And for the life of me, I don't understand how. When you think about Visa, it's the company we all know. It's the company we all love. And the belief, just like with Shopify, is that with agentic commerce, you don't need a Visa for payment rails anymore. I think that misses the fact that this company has, for the last decade, grown at effectively 10%, 11% on revenue, and it's expected to do so as we look ahead as well. So not a generational discount, but a discount over its multi-year history on a PE ratio basis for the same business that's just as robust as it was 20, 30% ago, and I continue to like it today. It's a long-term holding.
Long-term hold. Okay, Dan, that's all the time we have. Appreciate you joining us as always. Thanks so much. And thank you for watching Market Call. We will see you next time. Trading Day is next.